Hey, it's Diamond. I just watched an amazing video about the next credit era preparing for 2026, and I had to break it down for you. Let's dive in. All right, let's talk about credit because the entire world of credit is going through a massive shakeup. I mean, the biggest we've seen in over a decade. The old rules, they're basically being tossed out the window, and a whole new game is starting. By 2026, the way you get a loan is going to look completely different. So this is your playbook. This is how you get ready and how you win. So let me just ask you this. Imagine you're applying for a car loan or a mortgage, but instead of the lender just getting a quick snapshot of your finances, what if they could literally watch a movie of every single financial decision you've made for the past 2 years? And look, this isn't some far-off sci-fi idea. It's here. It's happening right now. And it is completely changing the game of how you're judged financially. Welcome to the new credit era. Okay, so let's dive into challenge number 1. And it's this idea of your financial movie. We're moving away from that old static picture of your credit and into something way more dynamic, a long-term view of your actual behavior. Let's break down exactly what that means. You know, for the longest time, we've all been playing by the rules of FICO 8. Think of it like a snapshot. A lender pulls your report and they see your balances on that one particular day. But the new model FICO 10T, that's the movie. It gives lenders a full 24 months of your financial history. We're talking the difference between a single photograph and a 2-year documentary about your money. So this is what that movie actually looks like to a lender. They can see the whole timeline. Are your balances consistently creeping up month after month, or are you actively paying them down? Did you carry a massive balance for 23 months and then suddenly pay it off right before you applied? They see all of it. Your patterns, your consistency, that's the real story now. But wait, it gets even more granular than that. Based on this 24-month movie, lenders are now assigning what's called a behavior classification to your accounts every single month. They're literally putting a label on your financial habits. Now, the classification you absolutely want to have is transactor. This is the A+, the gold star. It means you use credit, but you pay your statement balance in full every month. Lenders love transactors. They see you as responsible, low risk, and you're the one who gets the absolute best rates and terms. But then there's the other side of the coin, being labeled a revolver. And trust me, this is a huge red flag for lenders. This is someone who consistently carries balances from one month to the next, always paying interest. To a lender, that just screams higher risk and potential financial trouble down the road. So let's just look at how these different labels stack up on a risk scale. Transactor is, of course, the lowest risk. Then you have recovery. That's when you're making big payments to get out of debt, which is actually a good thing. Revolver, as we said, is high risk. And then there's deteriorating. That's when you're missing payments or going over your limits. That's the highest risk of all. Lenders see these actual labels now, not just a 3-digit score. All right, let's move on to challenge number 2, because this one is a real shocker for a lot of people. It's not just about your credit report anymore. Your everyday checking account activity is now part of the equation. You've probably seen that little Plaid logo pop up when you're connecting a bank account to Venmo or some budgeting app, right? Well, here's what you might not know. Services like Plaid are analyzing all your banking data and then packaging it into their own lending score. And then they sell that score to financial institutions totally outside of the normal credit bureaus like Experian or TransUnion. And get this, look at what they're actually tracking. It's not just your balance. They can see your entire overdraft history for the last 2 years. They analyze your income patterns, your money in versus money out ratio, and maybe the craziest one of all, they assign you a paycheck to paycheck indicator. Yes, they can literally tell a lender if your bank account hits 0 right before you get paid. Okay, time for our third big challenge. And this one, well, it hits close to home for millions of us. We're talking about those small, seemingly harmless, buy now, pay later loans. They now have a much, much bigger impact than you think. Think about it. The average buy now, pay later loan is just $150. Feels like nothing, right? Just a small purchase split into 4 easy interest-free payments. But in this new credit era, even these tiny little financial choices are being put under a microscope. But here's the thing you have to understand. It's all about how the lender sees it. You might think it's just a convenient way to pay. But when they see a pattern of you taking out lots of little loans, they start to think one thing: financial distress. They're wondering, why does this person need a loan for $150? Are they stretched too thin? And believe me, this has very real consequences because FICO 10T is now approved for mortgages. Your buy now, pay later history can actually influence whether you can buy a home. Of course, any late payments get reported. And just using these services too often can get you labeled as a higher risk, even if you never ever miss a payment. Okay, wow. So we've covered the financial movie, your bank account basically reporting on you, and the buy now, pay later effect. It sounds pretty daunting, I know. But here's the good news. There is a clear path forward. So let's get into the solution, your winning strategy for 2026. And this is where we have to get serious for a second. The clock is ticking. Experts are saying you've got about 12 months, maybe a little more, to really get your financial habits in line with this new world. After that, anyone who hasn't adapted is going to find it a whole lot harder to get the credit they want. The time to start is right now. So what's the game plan? It's actually pretty simple. I'm going to break it down into 3 clear, actionable steps for you. First, keep your credit utilization under 10% and do it consistently. This is priority number 1. Second, manage your Plaid connections. If you have a checking account with a history of overdrafts, maybe disconnected from apps you don't use. And third, use buy now, pay later strategically. Think of it as a tool, not a habit. Use it rarely. And if there's one thing, just one thing you take away from all this, let it be this. The old trick of just paying down your credit cards right before you apply for a big loan, yeah, that's officially dead. It doesn't work anymore. Lenders can see your whole 24-month movie. Consistency, positive, healthy financial behavior, month in and month out, is now the only thing that matters. So look, the new rules are out. The pieces are on the board, and the game has already started. This isn't about being scared, it's about being smart and being prepared. The new credit era is here. The only question left is, are you ready to play? If you're ready to fix your credit yourself, I've got you. Click the link in the description for free credit repair tools. No gatekeeping, just real results. If you want more videos like this, be sure to like and subscribe to the channel.